When you think of the AI data center boom, you probably don't think of sticky notes and safety goggles, but they're suddenly trying to change that. Welcome to Earnings Unscripted. Today's July 21st, 2026. We're breaking down 3M's Q2 results, ticker MMM, and it's a remarkably strong print. Adjusted sales landed at $6.5 billion and adjusted earnings hit $2.40 a share, easily beating what Wall Street modeled.
Yeah, it's a genuinely impressive setup. They didn't just beat, they raised the full year guide. But what's standing out to me isn't the top line. It's how aggressively they squeezed cash out of the existing system. I mean, they wrung serious efficiencies out of a pretty mature manufacturing footprint.
Well, Wall Street loved whatever they wrung out because the stock gapped up hard pre-market and closed up over 7% today, which, by the way, means I should probably toss in our quick legal disclosure that we're just sharing personal opinions on these moves. So please don't take any of this as formal financial advice.
Fair enough. And look, the tape's completely agreeing with management today. They pushed through broad productivity gains, like dropping the cost of poor quality across the board. That nudged adjusted operating margins up about 40 basis points year over year.
Right, and they did it without buying a ton of fancy new gear. There's this fantastic little anecdote from the call about a cable accessories plant up in Minnesota. They literally just locked the production schedule, mapped out material flows to find bottlenecks, and squeezed out a record month just using old-school industrial hygiene. No new equipment needed.
Exactly. Good old-fashioned manufacturing discipline, except that only takes you so far. At some point, you run into macro reality, and the consumer segment's showing some real cracks. Management called out an abrupt drop-off with a couple major U.S. retailers in June. If that destocking leaks into the back-to-school season, those tight margins suddenly look a lot more fragile.
Absolutely, and they still have those creeping oil input costs dragging on them. But honestly, the piece I can't stop thinking about is this massive internal gut job. I need to understand why a legacy conglomerate is suddenly tearing out the drywall and handing over its entire global finance and HR operations to an external AI partner.
Because they're tired of operating like 5 different regional fiefdoms loosely taped together. Look, 3M's historic problem was this sprawling, decentralized structure. Every region essentially ran its own back office. Now they're finally shifting to a highly integrated operator model, handing off all that duplicative overhead to AI and automation to strip out costs.
Okay, so instead of having a finance department in Germany and a completely separate HR hub in Japan, they just funnel it all into one automated global partner. That's, ruthlessly efficient.
It's the only playbook left if they want those mid-40s gross margins, and they're pruning the portfolio to match. They just folded their firefighter breathing apparatus division into a joint venture with Madison Fire and Rescue, kept a majority stake, but released roughly $700 million in immediate cash.
Wow. So they're just optimizing the entire machine to squeeze out liquidity, which makes sense for a mature industrial player.
Right, but that's what actually caught me off guard. The legacy optimization is just the funding mechanism. The real story here is their Microsoft Azure deal. I honestly think it's one of the most under-the-radar AI plays on the market right now.
So wait, Microsoft Azure. What's the overlap there? Are they buying branded sticky notes for the server racks?
Not quite. It's a pure hardware infrastructure play. 3M's deploying something called Expanded Beam Optics, or EBO. They've essentially become the official technology supplier for Microsoft's new AI data centers.
Hold on, I need to visualize this. Optics. So they're manufacturing the actual long glass fiber cables that connect all those massive servers together. I didn't even realize they had the fabrication scale for that.
No, that's not quite it. They aren't making the raw cable itself. The glass isn't the problem. The bottleneck for hyperscalers is the highly skilled manual labor. When you build these server farms, technicians have to physically cut, polish, and perfectly align individual fiberglass fibers point to point. It's painfully slow. 3M took an older optical patent they had sitting around and adapted it into a specialized connector.
Ah, got it. So they basically turned a fragile manual splicing job into, what, snap-together Lego bricks?
Precisely. Let me quote Bill Brown directly from the call because he framed it perfectly. Quote, "It is very durable, dust-resistant, vibration-resistant, fiber-optic connection technology. We've proven with a hyperscaler that it can reduce by about 85% the time to revenue," unquote. Microsoft validated the tech, and Azure locked it in.
Okay, that kind of massive time savings is completely absurd. If you're standing up a hyperscale facility, those saved weeks translate to ridiculous money. But wait, if they own the patent on this connector, are they just hoarding the production? Because I can't imagine one manufacturer keeping up with global data center demand right now.
They know they can't. That's why they're aggressively doubling their own EBO capacity this year and planning to do it again over the next year and a half. But more importantly, they moved fast and licensed the patents out to 44 different partners.
That's incredibly shrewd. You establish your proprietary connector as the underlying industry standard, let 40-something other companies take the capital risk to manufacture it, and you just collect the royalty checks.
Exactly. The total addressable market for these connectors is projected to hit $2 billion by 2028. It completely rewrites the growth narrative for a company everyone just assumes is a tired dinosaur.
It's fascinating. But if this EBO tech and those structural overhauls are driving so much underlying momentum, does it actually shield them from the broader macro picture? Like, how does a soaring AI infrastructure deal weigh against those memory chip shortages they warn are going to crush consumer electronics volume in the back half?
It's the classic tug of war, honestly. The data center upside is massive long-term, but those chip constraints are going to hurt the consumer side right now. Bill Brown was incredibly blunt about it. Quote, "The market data indicates a deteriorating production volume of devices, PCs, tablets in the back half of the year, expected to be down high teens," unquote.
Okay, high teens is a brutal headwind for any segment, which makes the overall outlook almost confusing. I mean, they still bumped up their full-year earnings target, right?
They did, yeah. Management clearly believes their core industrial strength outweighs those isolated weak spots. They raised the adjusted EPS range for the year to somewhere between $8.80 and $8.95, and they lifted their free cash flow expectations right alongside it. They're basically betting that their internal efficiencies completely swallow the consumer slump.
Right, but what happens if the global picture doesn't play along? We know they've been eating tariff penalties without seeing any government refunds yet. Does that aggressive thesis still hold up if broader manufacturing starts rolling over?
Well, here's the wild card. While everyone else complains about a catastrophic environment in Asia, 3M is quietly thriving there. They noted the domestic industrial economy in China remains pretty solid for them. Their balanced footprint of local manufacturing versus export is protecting them while competitors get squeezed.
It's such a bizarre contrast. You've got an old-school industrial titan pushing safety gear, but they're secretly accelerating Microsoft server farms and easily navigating Asian trade headwinds. It actually makes you respect the hustle.
You have to. I'm usually the first to point out conglomerate bloat, but they're doing the painful work of unwinding it. If they can successfully scale that optical tech, Wall Street has to completely re-rate their multiple.
Okay, so the old dinosaur might just lead the Silicon Age after all. I think that perfectly sums up the quarter. Thanks for hanging out with us, and we'll catch you on the next one.
Always a pleasure. See you next time.
If this breakdown saved you some reading time today, maybe tap follow so the next episode pops right into your feed. Just a quick reminder that this whole show, both our voices and the script, is an AI-generated project, turning the actual 3M earnings call into a conversation on the exact same day. We're always looking for new companies to cover, so shoot your ticker requests over to earningsunscripted@datamadness.ca, or just find the X link down in the show notes. Thanks for listening.